While the market appears to be shrugging off a trade war fears for now, our next guest has a new op-ed in the Wall Street Journal saying that China's unfair trade practices have little to do with the trade deficits and bilateral trade agreements that President Trump has been railing against. Joining us now, we welcome back Alan Blinder, of course, economics professor at Princeton and former vice chair at the Fed. Professor Blinder, always good to see you. Thanks for joining us.
Thank you.
And your new book is called Advice and Dissent. We need to get that in there as well. Congratulations on that.
Thank you.
Essentially, you're saying in your op-ed piece that to look at only the bilateral agreements is too simplistic. When you consider the whole global economy, everything works out in the wash, right?
Well, sort of. But the first part of what you said is exactly right. We should never focus on bilateral trade deficits or surpluses. They're inevitable in trade. The multilateral deficit that we have is large, and it means that America is investing, that's good, much more than it's saving, that's not so good. And if you do that, you've got to look somewhere else to borrow the money, and fortunately, we're a very credit-worthy nation that attracts a lot of foreign capital. We do it with ease.
But here's where I was getting and where it works out in the wash. You pointed out something that Paul Samuelson said, talking about comparative advantages. Where we are better at things than China is and vice versa. Treasuries, we sell a lot of treasuries to finance our future, and that's where some of that works out in the wash, right?
Yeah, that's right. That's right. There's an arithmetical identity that says what you borrow from abroad is equal to the flip side of your trade deficit. That's arithmetic. And we're not going to beat the arithmetic.
Are we investing? Oh, go ahead. Finish your thought. I'm sorry.
No, as I said, we're fortunate. Other countries are not so fortunate that we can borrow at low interest rates and not worry about, at least for a while, maybe a long, long while, a drop in the currency value. Other countries that ran anything like that size of a deficit might have real clear and present dangers, but we don't.
Are we borrowing to invest, or are we borrowing to spend? And is the heart of the multilateral trade deficit that America and Americans spend more than we make?
Yeah, that's exactly the heart of it. Given that we spend more than we make by a very large amount, about 3.3 1/3% of GDP or something like that, we have to run trade deficits with the rest of the world. Now, does it have to be with China mostly? No. It could be with other countries. As you no doubt know, a lot of stuff that counts as coming to the United States from China is using China as a way station, coming from somewhere else. The Chinese do something to it and send it to the United States. But the fact that we don't save enough compared to what we invest means we have to have this big deficit with the rest of the world.
Professor, do you think the Federal Reserve should take into consideration what's going on with the trade war in terms of determining whether or not they go ahead with their forecasted path for monetary policy?
Yes, but I think the impact on the Fed on monetary policy is likely to be pretty small unless this trade war gets a lot worse than seems likely right now. So it's a bit inflationary, and the Fed cares about that. It's a bit contractionary on the overall economy, and the Fed cares about that. So it's like a supply shock. If you just imagine this is like a small oil shock. It's not oil, although oil's going up also. So you can think of it as kind of magnifying the effects of a supply shock, analogous to an oil shock, but at least so far not being large in magnitude.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.